Last Sunday, I wrote about oilfield activity, specifically oilfield activity outside the US. I noted that across the US and Canada, drilling rigs were down 5% year over year, but in the rest of the world, they were up 18%. And in that post, I highlighted some important gains that we've seen in Ukraine coming out of the conflict with Russia, Mexico, Iraq. There's other big activity gains happening outside the US. And this is something that, again, if you've been watching oilfield service earnings calls, you're aware that the largest global oilfield service companies are looking outside of North America for their growth in the near term, and that's exactly what the drilling rig count data is bearing out. My next post was about the historic construction boom that's happening in the U.S. manufacturing sector. I wrote a somewhat lengthy Substack post about it where I included a bunch of different visualizations showing just how aggressively construction spend in U.S. manufacturing is ramping up. We've seen a doubling of construction spend year over year in the U.S., whereas the non-residential sector with the second highest increase in spend is commercial, and that's only gone up 24% in the past year. So we're seeing a concentration of spend happening in construction in U.S. manufacturing. And I wrote about that, it's these three big pieces of federal legislation that are helping out tremendously: the CHIPS and Science Act, the bipartisan infrastructure bill, the investment, or the IRA, the Inflation Reduction Act. All three of these are driving substantial investment into into emissions mitigating energy technologies, and that leads to a lot of construction activity here in the U.S. within what's classified as the manufacturing sector. So that gets to some onshoring, some reshoring of the supply chain, in addition to very specific energy investments, and we can absolutely see all of that happening in the data. My next post was about U.S. electricity. And what I did was compared the first quarter of electricity generation in 2022 against the first quarter of 2023. What we saw there was natural gas has grown the most of all the energy generation technologies. In 2022, the first quarter, natural gas generated 36% of the U.S. total electricity. This year, it was 40%. We saw wind go from 12% to 13%. We saw solar go from a little under 3 to a little over 3. And basically the growth across all three of those generation technologies is coming at the expense of coal, which was responsible for 21% of U.S. power generation last year and only 16% this year. So this ongoing change that we've talked about a fair bit across U.S. electricity is happening even more aggressively, frankly, than we would have otherwise expected given recent historical trends. My next post was about inflation and how inflation has gotten cut in half from last year to this year. In May of 2022, the inflation rate was 8.5%. In May of 2023 is 4.1%. And the huge change that we've seen year over year is a reduction in energy prices, both for the commodities itself and for energy services. I did point out in that post, though, there are two areas that are even hotter inflation-wise now than they were a year ago, which is strange because we've had all these interest rate increases, but two sectors are growing, prices are growing even stronger now than they were a year ago, and that is food away from home and services, less energy services, which are things like rent and car maintenance and airfare, that kind of stuff. So it's the inflation landscape is changing. It is improving in aggregate. There are still hot spots, though, where prices are still running way too hot relative to what the Fed would prefer to see for the whole economy. My next post was about the announced merger this week between Patterson-UTI and NexTier. And this is going to create a multi-billion-dollar North America oilfield service company whose offerings span the spectrum from drilling into completions. And that's important right now because we're seeing the same sort of consolidation happening on the operator side. Say specifically, we had the recent announcement where Chevron expects to buy PDC Energy. We're going to see more of that kind of thing happening on the E&P side, and we're seeing similar things happening on the services side. On the services side, it's in part to match the consolidation that's happening on the operator side. So it helps if the operators are bigger, the service companies themselves are also bigger and better positioned to serve these broader needs across larger operator communities. But also there's just a push for investors to try to extract as much capital from oil and gas as they can. And at that point, you want bigger businesses that run more leanly and have longer cash flow trajectories out into the future. That's how you're going to win investors over at this point, not some argument about how you're going to make the business worth so much more than it's worth today. The argument is, hey, we can generate a lot of cash today. We can continue to generate that much cash or more going forward. And that drives a lot of this consolidation that we're seeing. My last post for the week was about the IEA Oil 2023 report. And that is a forecast outlook from 2023 to to 2028. And it covers the gamut of the oil market. There was one bit that I highlighted in there that I wanted to share, and it was about oil demand. And it was interesting that the IEA expects improvements in energy efficiency to mitigate more oil demand between now and 2028 than any ramp in EV sales. And they do expect a sizable ramp in EV sales. And my point here was just energy efficiency is so easy to overlook. It doesn't get a whole lot of volume in terms of chatter around it because it's not sexy, it's not super disruptive. There aren't huge R&D resources deployed against it, at least in very visible ways that we would go carve out and celebrate. And so it's interesting. It's just another data point to keep in mind that not everything that's bright and shiny in the energy landscape should take as much of our attention as otherwise would. EVs are incredibly important. I'm not trying to argue they're somehow being oversold necessarily, but they do get a ton of press, a ton of media attention, a ton of analyst attention, and something like energy efficiency can be even more important for the duration of this decade, and it's pretty important that we talk about that. On Saturdays, every Saturday, I send out a free weekly newsletter that includes links to and summaries of all the research that I publish during the week. I make sure to include at the end of it an energy-related anecdote, insight, or observation, so that even if you've seen all the LinkedIn stuff that I've shared, or Substack, or wherever else I happen to share it, there will be something new for you in the newsletter because I don't share that piece of it anywhere else. This week, I wrote about the Patterson-UTI merger, but I also wrote about with NexTier, but I also wrote about the Duke Energy's sale of its commercial renewables business to Brookfield and how those two different business transaction announcements tell us basically two sides of the same coin in terms of what investors are paying attention to as we navigate through the energy transition. So if you're interested in having access to all the research stuff that I publish so that you don't have to rely on LinkedIn to show it to you, you don't have to scour through it to go find it, it's all in one place. And if you're interested in having this energy-related anecdote, insider observation, sign up for the newsletter, totally free, comes out on Saturdays. It's a pretty fun way for me to try to stay in touch with you and give you more easy access to the kind of stuff that I'm sharing. So as always, thanks a bunch for reading, for watching, commenting, all the rest, and I'm sure we'll talk soon. Bye-bye.